the sad part is today, everybody is becoming more and more short-term in nature. I keep saying this to a lot of people, who follow me on Twitter, that that long-term investing is losing its value. Either you have people who are in the Warren Buffett camp, buy and forget, or you have people who are only looking at day-to-day moves.
Right.
The fact that the weekly options in today's market is garnering more open interest than the monthly options is a dangerous place to be in.
Right.
Because everybody is trying to play T20.
Right.
Nobody wants to play the test anymore.
Right.
So I personally feel the reason why Goldilocks premium research came into play is because I want to capture big trends.
Correct.
And if you actually speak to market participants, who've made serious money or who've made a fortune, you will realize that it's only in certain phases, say 2003 to 2007, and then 2013 to 2017. It was these phases, where they actually made their entire wealth. Not trading the market every day, not looking at the market every day. I'm sure there are many people doing it. I'm happy for them. But my school of thought is if you have to make a fortune in the markets, you have to look at the bigger trends. And when I say bigger trends, you can look at the weekly chart, you can look at the monthly chart. I don't want to take any stock names, but many of the top stocks which have done well in the last 18 months, they would not have broken their moving average for 18 months. You could have simply, held some of these stocks and, you would have done extremely well. So I feel that technical analysis definitely can be used for the long term. It should be used for the long term. And if you're looking at it short term, more than the analysis, it's the discipline and the risk management, that will take you to your financial goals.
Absolutely, absolutely. In fact, Gautam, I do follow you on TV and your social media, Twitter. And I see that you are a very macro person. You develop a very macro view about the market and then you dig down into the sector specific and then probably you get into the stock specific.
Right.
That is actually a very unique way of looking at the market. Whenever I meet technical analysts, they typically focus more on stock.
Yes.
And they don't look at what the market is trying to do at a macro level.
Yes.
So give us some insight about that theory.
Yeah, so, in my initial years of learning, so I have been in touch with my mentors and they've always told me that in markets, you have to have a top-down approach. So firstly, you have to be positive, on the index. If you're positive on the index, then you look at some of the sectors within the index which are outperforming. And I look at a lot of relative strength charts. A lot of people, for example, would be looking at a Nifty and a Infosys separately. I look at a relative strength chart which is Infosys over a Nifty. And if that very chart is trending upwards, not only does it mean that Infosys is doing well, it also means that Infosys is beating the Nifty. And given what has happened in the last many years, it's, as you might be aware, it's so difficult to beat the Nifty these days. So if you can beat the Nifty, you've done extremely well. So I think this approach of top down has worked very well for me. And within the sector, after I see some relative strength, I look at handful of 3 or 4 stocks, which have outperformed. In the current situation in the banking space, there are few stocks, Bank Nifty is today near lifetime highs. There are some which are trading at lifetime lows and people still want to buy them because they feel they are cheap.
Correct.
And the expensive ones, price-wise and valuation-wise, continue to run up. So this, I think, is not going to change. This mantra of having a top-down approach is not going to change. And I think I would recommend your viewers to actually study the markets in this way. I'm sure they'll come out a winner.
Also, Gautam, because we have worked in JM Financial, which I guess is one of those firms who has a right mix of retail investor base as well as the institutions.
Yes.
And you were the key part of that management. So obviously you have an experience of handling both the category.
Yes.
Do you think any difference between both the category in terms of their understanding the market or the way they participate in the market?
Well, honestly, if you ask me, there is not so much of a difference. It's just that between retail and institution, the numbers might be bigger. An institution might have better English accent. But apart from that, I think the psychology for most, are pretty much the same. If you actually look at the F&O data, which comes out from NSE on a daily basis, and people used to at some point of time follow the FIIs as to what they did in the markets. And if you see in the last many years, that has reduced quite a bit. People don't think that FIIs are are the ones who are taking these markets higher on a regular basis.
Right.
And I would say there was a revolution which happened a couple of years back. The fact that domestic money in India today through SIPs is 9,000 crores.
Right.
I think this advent is a revolution.
Right.
And I would definitely, want to believe that this is only going to get better.
Right.
And this makes me believe that in today's market, there is no single person who is a bigger market participant.
Right.
In that sense, when I speak to retail or an institution, it's the mindset which is slightly different.
Right.
Otherwise, I don't see much of a difference. And but the good thing is that the retail has got a little more, has some more risk management in place, which was not the case earlier.
Okay.
So in that sense, things have evolved.
So the quality of retail investors or traders now in market, you think has improved over vis-a-vis last probably a decade or so?
I think so. I think a lot of portfolios have gone into passive equity, as I said.
Right.
And the ones who have active equity, have now understood that if you do not have risk management, if you do not play stop loss, stocks can go down to zero.
Right.
Stocks can go down. It can be a penny stock. And you've had so many examples in the last 12, 18 months.
Right.
So yeah, that's there.
Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.